Welcome, everybody. Appreciate you joining us today for our webinar, Deal Sourcing Strategies for Volatile Markets. It's brought to you by the leaders in private equity education, private equity career news, and PE professional. I'm Mike Waite. I'm the CMO at Sourcescrub. We are a deal sourcing platform for deal makers who are looking to find, research, and connect with the best private market opportunities out there. And I'm grateful this morning to David Toll for inviting me to host. Really looking forward to the conversation. Based on the response and the number of people we have signed up, this is a super popular topic. I think everybody is trying to find their way through another period of uncertainty, and hearing from our peers and learning from their experiences is a really helpful thing. So I'm grateful for our panel. We've got a great panel today and appreciate them agreeing to join us today. Just a couple of housekeeping things before we get started. A friendly reminder, if we have any reporters on the phone, that we are off the record. And so I would ask that you please contact our panelists or David or myself directly if you would like introductions or any statements or any comments about the content we're about to discuss on the record. Second, we have provided in the download section of the platform a copy of results from a 2023 survey of BD professionals. A lot of valuable information in there on industry practices and business development. You can just go to the handout section of the GoTo platform, which has the little paperclip, and you'll find the content in there. We will be sharing a recording of this with everyone who registered, whether you attended or not. So no need to be taking furious notes. We will provide that recording for you for your convenience. And finally, when many of you registered, we invited you to share questions. We've taken note of those, and we'll be including a lot of them during our panel conversation today. But for questions along the way, I encourage you to use the question panel that's in the GoTo platform. We'll be keeping an eye on it. We'll be introducing those questions throughout the session today as we go through today's conversation. We're planning about 75 minutes. We'll see how it goes. I have a feeling with the number of topics we want to cover and for panelists that we will take advantage of all of that time. So hopefully you'll be able to stick with us for the entirety. So as I said, very grateful for the panel we have joining us today. Jonathan Babcock, Senior Associate Business Development at Compass Group Equity Partners. Justin Loeb, Managing Director at Clearsight Advisors. Heather Madlin, Managing Director and Head of BD at Novacap. And Kate Trendle, the Managing Director at Kips DeSanto and Company. So why don't I give you guys a chance to elaborate a little bit more, introduce yourselves, maybe give us a little bit of professional background on you and your role, and maybe tell us just a little bit about your firm and where you focus. Why don't we just kind of go through it in that order that we started with? John, why don't we start with you?
Yeah, this is Jonathan Babcock with Compass Group Equity Partners, located here in good old St. Louis, Missouri. Lower middle market focused on partnering with family founder-led businesses. Call it 2 to 15 of EBITDA, so really first institutional capital in, but we take a thesis-driven approach to the market where doing a deep dive in overarching sectors, niche manufacturing, value-added distribution, business and consumer services, but then find interesting niches and spend as much time as we can in those to get strategic.
Thanks, John. Justin, how about you?
Absolutely. Thanks so much, Mike. This is Justin Loeb. I'm a managing director at Clearsight Advisors, and I also lead our financial sponsor coverage function. So Clearsight is a 50-person M&A advisory firm exclusively focused on working with businesses in the knowledge economy. So think white-collar professional services, IT services, marketing services, as well as some tech-enabled services and software businesses. We are based right outside Washington, D.C., with a satellite office in New York City, and we are primarily providing sell-side M&A advisory to founder-owned businesses as well as private equity-owned and other institutionally backed companies in the knowledge economy. I started my career right out of undergrad in M&A advisory at Harris Williams, and then joined Clearsight about 11 years ago and launched the sponsor coverage group about 4 years ago.
All right. Thank you for that. Heather, why don't we move on to you?
Sure. Hey, happy to be here. Heather Madland, Managing Director at NovaCap. Most of you have seen me when I was at Huron Capital for 11 years. So I recently joined NovaCap about 6 months ago. I have spent my entire 25-year career in and around the middle market M&A ecosystem, starting in leveraged finance and moving over to private equity about 15 years ago. NovaCap is a 4-decade-old private equity firm based in Montreal. We are a multi-strategy, sector-focused middle market firm. We have just under 10 billion of AUM. 130 of us are spread across offices in Montreal, Toronto, and New York. We have a really heavy focus on thematic investing and driving operational value creation. We invest across 4 disparate strategies, each with its own sector focus and its own committed pool of capital. So it's a little bit longer of an intro because of that, but based on our AUM, our largest strategy is technologies. We're targeting buyouts of North American companies, B2B software with at least 20 of EBITDA. Our 3 remaining strategies include industries, which is our only strategy that invests exclusively in Canada today. Digital infrastructure and financial services round out the rest, and they target businesses with EBITDA between 5 and 25 million. Important differentiator for us, because most people ask, how the heck do you run BD for private equity firms? And our sourcing differentiator is we really go to market with dedicated sector coverage within each of our strategies via the investment team, which we call our sector leads. So we build ecosystems of referral sources, executives, and prospects, driving thought leadership, early conviction, so that we have more certainty to close when we see the deal we want to do. Thanks for having me.
That's great. Thanks, Heather. And that kind of focus is certainly an important part of being successful right now. So I look forward to diving into a little bit more about how that works for you guys. And Kate, if you don't, sorry for bringing up the end here, but Kate, why don't you tell us a little bit about your role at Kip DeSanto? And there
Absolutely.
we go. Yeah, I was going to say, Kate and Heather, we're not seeing you guys, but there we go.
That was weird. I'm not sure how that happened, but okay, we're back.
Good to see you. Good to see you.
Well, thank you, Mike and David, for including me today. Super excited to be on the panel and talk about the kind of crazy market we've had over the last few months. A little bit about me, as Mike said, Kate Trendle. I'm a managing director with Kip DeSanto. I've been with the firm for 10 years, and prior to that was at other investment banks that focused in the government space. Today, Kip DeSanto continues to be the largest and most active investment banking group that's focused on the government services market. We actually focus on federal government technology and solutions businesses, which is where I focus my time. I co-lead that practice along with a colleague. And we have 2 other practice areas. One is aerospace and defense manufacturing, and the other is enterprise technology, more of a commercial focus area. I mentioned that we're the largest, and that's by the number of professionals that focus in our sector. We've got about 40 investment bankers and 9 managing directors, and most active. We're doing anywhere between 20 and 30 transactions a year. And our average transaction size is around 150 million of enterprise value. So we really do play in the middle market. As I mentioned, I was at 2 competing firms prior to joining Kip DeSanto 10 years ago. So I've been doing investment banking in the government space for almost 20 years now. And Capital One actually acquired us 6 years ago. So you may, if you've heard of Kip DeSanto, you may have heard of that, which has been fantastic to have a partner and owner with Capital One. And then on my side hustle, when I'm not executing deals, is I lead our private equity coverage strategy, not necessarily coverage relationships. We share that across all the managing directors, but I kind of spearhead our thought process around coverage for private equity. So excited to talk about kind of the private equity market today.
Excellent. Excellent. So in case it wasn't obvious to everyone in the audience, we've got kind of a balanced panel here representing private equity firms and advisors. So I think we're going to have a really broad take on what's going on out there. And so why don't we jump in? After what felt like a really, really brief respite, it feels like uncertainty is back and bigger than ever. And I know based on our sort of pre-session conversation that you guys are all feeling that. I'm interested to hear a little bit more specifically about how the current environment is affecting deal flow in the sectors that y'all are focused on. And Kate, with your focus on government-related businesses and services, I'm guessing you're definitely feeling some kind of an impact from what's going on out there. So why don't we let you get started with the topic?
Yeah, and I could talk for hours on kind of what we've been seeing, so I'll try to be concise, but you're absolutely right. As I mentioned, our firm focuses very heavily on the government space, and I personally, along with several of my colleagues, focus exclusively on federal government services and technology businesses, and that is an area that has gotten unbelievably affected by the current administration and DOGE. We did not launch very many deals, if any, kind of between the late January, early February until pretty recently. And we have been very thoughtful about how to enter the market, given the overhang of what DOGE has already accomplished and what is continuing to be focused on, as well as new administration priorities. And I would say that pause that I mentioned, roughly a 3 to 4 month pause on M&A activity was felt across the entire sector. Interestingly enough, in the spaces where I focus, we actually have seen decent deal closings year to date. However, there's been a lot fewer new launches, and a lot of those actually closes that you may have heard about were hangovers from last year. So there has been a meaningful delay in kind of new starts for M&A processes and new deals being brought to market, as well as having a big impact on the size of deals that have been brought to market. So in the government services and tech space, in any given year over the last 5 years, there's been roughly 115 transactions happen each year, and roughly about, call it, 40% of those transactions, 30 to 40% have been companies that were over 100 million. This year to date, there's been less than 50 transactions that have closed and less than 10 in more than 100 million of enterprise value. So it's definitely have an impact on the quality, size, characteristics of deals that are getting done. That said, I think, June, July have been and are expected to be pretty pivotal months, as well as helping return the market to maybe the new norm. I don't know if we'll go back to where we were fall of last year, but it seems as though the M&A appetite is starting to pick up a little bit. So we are thinking very selectively and strategically about launching new businesses, and I believe some of our peers are as well. It seems as though deal activity is picking up. The positives have been, Elon Musk has moved out of DOGE, which has not stopped DOGE's activities, but it has adjusted and altered their focus areas and maybe the urgency in which they've been making cuts, as well as Trump releasing a skinny budget and the expectation that that should hopefully get passed over the next several months, which, at least if nothing else, shows sort of or lends some insight into who the losers and winners may be and where the government may be spending going forward. And the last trend that's been positive has been that some of the public companies in the space have seen some price improvement, which is helping overall kind of certainty and kind of de-risking the environment.
Yeah, it's interesting. It seems like the companies out there that are showing a lot of promise and potential, right? Those gems. The valuations and the activity is crazy, right? So it's this interesting sort of two-sided coin we have going on. Heather, why don't you
just to build on?
Go ahead, John.
Yeah, I was just going to build on. Completely agree with what Kate said. You got the opportunity to hear Josh Howard, Chief Investment Officer for Bremer, speak last week, and he talked about uncertainty and then Knightian uncertainty, where it's impossible to figure out what's going on. I feel like the last 6 months, that was the scenario we were in. PitchBook had some really interesting data. Any presidential election cycle, 12 months leading up until usually deal activity slows down. So if you look back to last year, I think that was pretty accurate. And then usually after we come to a head on the election, it picks back up and people were pretty optimistic moving into the new year. And then I think 120 executive, all these changes in tariffs, I think there's been 50 plus changes. So nobody can figure out what's going on. And that impacts a certain end of the market. You look at A&D, government services, that definitely has an impact. But broader market, Wall Street Journal had a recent report where they said, 45% of business owners said they were impacted negatively, whether it was directly from overseas sourcing. They were impacted, right? And what does that do to supply of deal flow? It takes a lot of deals off market. Heard from a number of groups just over the last 3 months that tried to launch a process, got out, maybe a month into the process, decided, hey, let's pause this, let's figure out, once tariffs come to a head. And so I think you're at a stage, especially in the lower middle market right now, where hearing from a lot of investment banks, if you're a business owner and, tariffs, even if they have an impact, but you want to get a deal done in 2025, now's the time to start launching those processes. So I would say the last month, we've definitely seen a pickup in activity.
I got to get more nimble with that mute button. General market sentiment certainly seems to reflect a little bit of sort of rebounding optimism. But I mean, Heather, I'm kind of curious from where you sit, how you're seeing things.
I don't know. I'm a little bit more cautious for Q2 than I was in Q1. I think overall our deal flow is holding. We obviously cover a lot of ground between geography and sectors. I'm keeping an eye out for signs of softening with some of the tariff disruptions announced in April. We certainly see our quarterly end of quarter pickup in deal flow happened in March. We'll see if that happens in June again. We're up about 3% overall LTM May, but really seeing more stronger growth, single to lower double digit growth in tech and financial services, which makes sense. Those don't tend to be as impacted by tariffs and maybe some of the recession fears as well. They're definitely showing more resilience. I would say quality of deal flow. Look, A+ assets are still strong. We see a lot of those. However, we are starting to see more B assets coming to market, which is good because we like those. A lot more founder owned. We have a founder owner focus and preference. So definitely seeing more of that. It feels a little COVID-y for founders who are more capital constrained or they're lower growth businesses. They're aging. But in COVID, we saw people just say, well, screw this. I'm sick of the last 10 years. Now COVID. Well, I think we're seeing kind of that trend happen again. Like other sponsors that I talk to, discipline is back. I think it's been here for a while, but I would say it's even stronger around the investment committee tables that I am part of. More disciplined underwriting for sure, focused on, recession resilient businesses, margin stable sectors, a lot of healthcare. We love asset light financial services, B2B software, like I said before, and infrastructure are certainly benefiting from some of that recession resilience. We're walking away from good but not great deals, especially if valuation guidance is aggressive, which we're going to talk about processes, but I think some of the types of processes that are being run are definitely driving up valuation. Good for you guys, Justin and Kate. And so I would say overall, my outlook for 2025 is I think Q2 is going to slow, frankly. I think unless we have more clarity with regard to the tariffs and recession chatter, I think it's already starting to have an impact. We'll see if an H2 rebound is possible, if, the macro environment stabilizes. But look, what's always been consistent and certain is that there's over $1 trillion of dry powder sitting in sponsors' pockets. And so the pressure remains to deploy capital for sure. So that's a little bit about what we're seeing.
Yeah. And I would maybe just jump in on that. I think you raised an interesting point, which is around, when we'll see that pickup, right? M&A from where bankers sit is a bit of a lagging indicator because we start processes about 6 months before a deal gets done, right? And so as I kind of mentioned earlier, we're just now starting to think about starting those processes with the expectation, again, I'm focused on government services more than other sectors, with the expectation to what Heather was just saying, not necessarily that folks are ready to close maybe next month or the following month, but that hopefully by the end of the year in Q4, if we're getting deals in market now, hopefully if the trends continue, there could be a good window kind of end of Q3 and Q4 to start see that M&A activity start to pick back up.
Yeah.
And Justin, I think you guys focus quite a bit on business and tech related services. I'm kind of curious to get your take on the industries you cover and what you're seeing.
Absolutely. Yeah, I echo a lot of what fellow panelists have already spoken about, and maybe for the industries we're covering, and as a reminder for the audience, it's white collar professional services, IT services, marketing services, and kind of tech enabled and software assets, what we call broadly the knowledge economy. And what we have seen over the last few quarters, maybe to boil down and summarize some of what my fellow panelists have just talked about, is if you're growing consistently, if you don't have a ton of customer concentration, if your margin profile is where it should be or above market standards, you're checking a lot of boxes for potential investors and strategic buyers, it's a really interesting time to explore strategic alternatives because there is a massive imbalance in the amount of supply of actionable, interesting targets out there and the demand from both private equity investors as well as larger corporates. One of the things that's maybe I can't really comment on other industries, but for our industries, one of the things that's really interesting over the last, call it 6 or 7 years especially, is the sophistication and growth of the M&A and corporate development teams at some of the most active strategic buyers in the knowledge economy. And that's happened at the same time all the trends that we just talked about with the private equity community has happened. And so there's a ton of dry powder, a ton of private equity firms that are excited about these businesses, but there's also more sophistication, more action, and more investment from the M&A and corporate development teams of some of the larger strategics out there, which only adds to increased competition for some of these assets. And so it's we've found that our processes this year have been very competitive. Valuations have been pretty robust, not to Heather's point, I think earlier, not 2021, 2022 levels, but pretty robust, as certainly materially percentage premiums to pre-COVID valuations for a lot of these end markets. And there's a lot of folks rolling up their sleeves and digging in, and that they've gone really well. And so it's definitely an interesting market, and for all of us, regardless of industry, the more certainty and conviction we can have macroeconomically and geopolitically, the better. But it actually is, if you check a number of boxes, it's a pretty interesting time to explore strategic alternatives for would-be sellers.
Yeah. So business fundamentals obviously always going to be really important, and certainly environment affects everything, right? So obviously a couple things we really want to keep an eye on. But Kate and Justin, I'm interested to get your take with your broader perspective on industries where you are seeing promising deal flow, where you are seeing deals advance.
Sure. Kate, you want me to start?
Sure.
So in our world, I would say, you can, this is a bit of a overgeneralization probably for our practice areas, but it's probably helpful, maybe easy to think about two primary halves of our business. One half more white collar professional services, and then the other half more like IT and marketing services. And on the IT and marketing services side, there's definitely a number of groups that we have very strong relationships with that we're trying to figure out correct timing on when to go to market. Some of them have seen softness in their business, not necessarily declining, but just not the same level of growth they experienced kind of through 2022. And so those aren't as obvious, and it's more company and shareholder group dependent on when exactly to go to market. On the white collar professional services side of our business, largely there's been some pretty good tailwinds in a lot of these end markets. And so whether it's kind of a strategic communications or PR services business, whether it's a restructuring advisory services business, as you can imagine, that end market is experiencing some pretty strong tailwinds and probably will continue to over the next few years. A lot of opportunities in the healthcare and life sciences consulting and advisory world, and also another very hot topic certainly from the private equity community, as well as the office of CFO services. So think like outsourced finance and accounting services, sometimes outsourced bookkeeping. That whole kind of office of the CFO services has been a very popular investment theme over the last few years, and frankly, feels like we're in kind of maybe bottom of the second, top of the third there, and it's starting to approach the excitement levels of what we saw a few years ago from investment in the managed services provider, the MSP or MSSP world. And so there's a lot of pockets where these businesses are growing, Mike, and there's a lot of excitement from investors and strategics alike. I would say we are seeing more momentum right now on the white collar professional services side of our practice, and maybe a little bit more caution and still getting back into growth mode for the IT and marketing services side.
And Kate, how about in more government related services where you guys focus? What are you seeing, and where are you finding the flow is actually happening?
Yeah, and maybe I'll maybe twist that a little bit, that question, because as I mentioned, our sector has been a little bit on pause for a little while, and the deal activity, I would say, through that pause has been less interesting. What we've been hearing is that there's been some less attractive assets that are in market, some C assets, B minus, and a lot of the A assets were being held. Because if you're an A asset, why would you go to market if there's no buyers buying? Why would you want to take either a massive valuation hit or not get a deal across the finish line? And so we're now, as I mentioned, starting to see our peers and we're doing the same thing, start to think about taking some of those A assets to market. And so maybe I'll answer that question as to what types of businesses in today's environment that focus on the government sector could get a deal done in today's climate, which is still pretty M&A risk adverse, just given what's still continuing to go on. And public companies in the space are still being very cautious to deploy capital, given that their public pricing is under pressure right now. And private equity and their ICs have been a little bit less focused on getting deals done in the government space for obvious reasons. So when we think about businesses that should do well in the new world, what does that look like? And I'd say that there's, probably kind of three, if I had to break it down, major areas that, that the businesses could still see. You mentioned, Mike, that there are businesses getting great valuations, right? There was recently a deal announced in our sector at a pretty frothy valuation. So deals are getting done, and deals can get done in a pretty attractive valuation parameter. And I would say one, and Justin kind of mentioned this, I believe, is around growth, right? It's really important now more than ever that businesses that go to market in the government space have their ducks in a row organically, right? You don't want to go to market right now with a major recompete up in 6 months, right? You don't want to go to market if you're down 20% because 3 of your programs just got whacked by DOGE and 3 more are currently being interviewed by DOGE, right? You want to go to market when you're showing momentum, growth, strong backlog, good pipeline, execution, et cetera, and can give a buyer confidence that your business is sustainable and can add synergies from a revenue standpoint to their book of business. And 2, alignment with the current administration. Trump released his skinny budget, and I think we can probably make some bets on who winners and losers are going to be. There's been a lot of executive orders and attention around certain agencies within the government, right? If you're a business focused on Space Force, Golden Dome, DoD, and you're focused on certain pockets that the administration has said they want to invest in, AI/ML, cyber, et cetera, certain areas around IT modernization, then odds are you're going to attract interest from certain buyers in the environment who are looking to align themselves more acutely with kind of expected budgetary trends going forward. If you're Department of Education, HHS, heavy Fed Civ, we'd want to be really thoughtful as to exactly what your book of business looks like, who the type of buyers could be, because that has not been top of mind for the most active buyers right now for obvious reasons around DOGE and the current administration's focus. And then the third bucket would be differentiation. The government services market is highly competitive. And so what is that business doing to differentiate itself? Is there IP? Is there non-FAR based, and sorry for using acronyms, kind of contracting if you have access to OTAs or SIBRs? For the folks that are in the government space, you'll know what those are, but kind of areas that provide less competitive revenue streams, or do you have strong margins or certain capabilities that are aligned with commercial software products that are being used? What are you doing that can differentiate yourself in the market? Those are the types of assets, Mike, that we're thinking thinking through bringing to market right now, even with some of that remaining overhang of uncertainty in the government space that should do well in this kind of climate, just because, they're solid businesses.
Great. So very clearly, there's sort of a bifurcation, right? A and A plus assets versus sort of all the rest in terms of interest and valuations. John, Heather, maybe we can get you in the conversation here and talk a little bit about what you're seeing in terms of valuations and multiples for those A plus assets. Are we at a place where they're just not interesting to look at because competition for them is so frothy? Or anyway, you guys answer the question.
Yeah, I think it depends on. Yeah, I mean, Heather, I think hit on it earlier, but I think it depends on really firmly understanding your investment criteria, where you're going to compete, where you're not going to compete, right? There was a fire and life safety deal. Probably some people on the call saw it, but, call it true sub 10 of EBITDA, got 100 plus IOIs. And generally speaking, that's not where we're focused, right? And so we got a BD best practices group with 12 other people, and we consistently trade notes on what's going on in the market. What are we seeing? And I think the key theme is really one, understanding, are you that 13 times buyer on a 5 of EBITDA business doing, industrial services? There was another one that got 76 IOIs, and you really had to be in that 12 to 13 range, which I think is unprecedented. But back to Justin's point, I think there's a bifurcation in supply and demand. And, if you're a good business that checks all the boxes, no tariff exposure, you're going to get, I think, a premium valuation. And so I think you just really have to understand where you're going to compete. If you're that buy and build model, maybe it works that you're paying 13 times and then trying to buy it down with 16 add-ons. It's not really our focus. I think being strategically focused in the market, similar to Heather, where we're out there and found this out right before the call that we actually partnered with her cousin, Ken Sussex, on the restoration services side. Great industry. Yeah, too small of an M&A world. But, we take a deep thematic approach where we're not saying put a few bullet points out on a one pager. Let's see if we can find something in the space. Let's go out, similar to Heather, go out, talk to every center of influence, every industry executive that we can possibly find, get smart in the space over the course of 2 years, and then really resonate with that owner and find them through, hopefully, Kate, Justin, hopefully out of a process. No demise to you guys, but hopefully that's where we're focused, and finding unconventional paths, getting in person. I think more city trips, that was another thing coming out of our best practice group. More people are, if you go to the same conferences, you're going to see the same deals, and you got to get out in the market and have a strategic approach. And Hugh MacArthur from Bain, I think he was even quoted, there's even a bifurcation between funds right now. They're having a quick fundraising process if you have that deep thematic approach. And so that's really how we focus. And it sounds like, similar to Heather, but I'll let her chime in.
Well, I'm going to actually put some stakes in the ground on valuation multiples. So maybe this will elicit a debate among us, but I would say middle market companies still command low digit, premium A plus businesses are commanding low double digit multiples, 12 to 14 times. Where companies that we're seeing snag another 1 to 2 plus turns are recurring revenue models with strong customer retention. And John, you certainly spoke to that with some of the sectors you guys invest in. And Kate, strong organic growth is a must have for these types of multiples. I mean, these are all things private equity wants to see: predictable, sustainable, recurring cash flow. And I would say in particular for our tech fund, larger, profitable B2B software or services businesses that have proven upsell and a deep product fit, these companies are going for premium valuations. Healthcare IT is one of our sectors within technologies, and 2 of our last 4 platforms have fallen within that sector. Compliance, GRC is particularly active, as well as anything that touches data or data analytics, information services, I would say as well. But look, I mean, I think the point I wanted to make is scarcity value is alive and well. I hear you on the broad processes and people submitting bids, but where the way that we go to market, we see much tighter processes. And I would really point out 3 major drivers of ultra premium multiples in this market today. Otherwise, I think people are being fairly disciplined, and a lot of those boxes need to be checked for a premium multiple. Look, if you're a category leader, and there's fewer of those companies out there, and in sectors like specialty healthcare, IT, industrial software, digital infrastructure, there are only really a handful of scaled platforms, that are platform quality assets. And when these come to market, like, these are highly competitive and they're pushing valuations above 15 times in some cases. The other area where we're seeing ultra premium multiples is long holds, high quality assets. And so we're going to touch on this a little, but we call, cash cow assets with low customer churn, high margins, recurring revenue. They're staying private longer. I mean, we have seen through all the reports that private equity, the average hold period for private equity portfolio companies has extended 1 to 2 years. And we know that. We know that because we like them and we're recycling them into continuation vehicles, which is further tightening the supply for some of these A+ assets. And so when they do come to market, it's just lifting the price of those deals beyond our reach in a lot of cases, frankly. And then finally, regulatory moats and specialized technology. I'd say companies with IP, regulatory complexity, long-term contracts, like a lot of our digital infrastructure deals have. Look, I mean, scarcity, defensibility, that equals pricing power. And I feel like, when those businesses do come to market, those tend to be going for ultra premium multiples as well. So in a nutshell, I think the lesser performers just reverse everything I just said. But one thing that I'll point out is that growth at all costs. You see this in software businesses who aren't profitable yet. You see this in M&A buy and builds where it's scale for the cost of scale for the sake of scale. These are all being discounted today. We saw what happened kind of post-COVID with some of these companies coming to market that were not integrated. So I would say growth at all costs, we have less tolerance, and I think the market overall does as well. And then finally, from a leverage standpoint, just because if folks are curious, I would say, the non-bank, lending market is alive and well, as we all know. And you can certainly get leverage for some of the valuations that we're floating today. We're not all taking it, though, of course. So
Heather said she was trying to. Thank you. That was really, really great detailed answer and summary. But Heather said she was trying to stir things up there. I'm just interested if we've got any other sort of contrary points of view you guys want to throw out.
Single digit multiples. So I would say, like, absolutely, manufacturing and some of those other industries that we focus on in Canada are certainly commanding less than that.
No, I think that's right. I think Heather, all that commentary I think is very alive and well with the sectors that we're focused on here at Clearside. And again, and that kind of goes back to what I was saying earlier. Like, what we're seeing from a valuation standpoint are still things that are north of, like, very heavy premiums above pre-COVID levels, right? And so, yes, for some of these digital services assets, they're not going for 20 to 25 times EBITDA anymore. They're only going for 15 to 20 times, right? Which, to be fair, is a very material difference, but it's still far and above, the 8 to 10 times we were seeing for some of these assets in 2017, 2018, 2019. So that really resonated for me and certainly for the industries that I'm focused on. One thing, while we're trying to stir the pot, one thing that I will delicately suggest to maybe stir the pot a little bit, just because I hear it so often, and I think there should at least be an asterisk next to it, but everyone just loves talking about, every single person I talk to, right, says, A+ assets are the only thing getting done, and you got to do all this and that to get a deal. And it just couldn't be farther from the truth. And I think A+ and grading businesses that way is maybe a little bit too simplistic. And so the way I think about it is kind of complexity or lack of complexity, right? And when there's more complexity, typically investors have to underwrite that complexity in, and that could result in a lower valuation. It could result in fewer bids and less competition for the asset, et cetera. the reality is, like, I think, the clients we're bringing to market are fantastic businesses. I think it's kind of impossible to make an argument that for example, a couple of the divestitures and carve outs that we've already done this year, that there's not more complexity inherent with those transactions than with a normal founder owned or private equity owned sell side process. And even in those situations, as examples, tremendous amount of interest, great deals getting done. And so I just I'm getting a little bit of an echo. I don't know if you guys are too. Okay. But just in those examples, right? There's certainly more complexity with any corporate carve out, and we're still seeing a ton of interest from both sponsors as well as larger corporate acquirers. And so I kind of want to dispel that notion for folks listening that either owner operators or are investors and on the board of certainly at least companies in the B2B services world and tech-enabled services world, like you don't actually have to check every single box, as long as, again, you're growing, the margin profile makes sense, you don't have a ton of customer concentration. Chances are there's going to be a lot of interest, and valuations, to Heather's point, are actually probably going to be pretty robust if you're running a competitive auction.
Yeah,
I would completely agree. I would say, I don't like the ranking system as well, but I think it's a mode for just identifying what checks 8 out of 10 boxes. And I think those deals are still getting done. One in particular, got 90 plus IOIs. And I think there's this return, we were in a low interest rate environment, right? Money was essentially free for a long time. And now that we're coming out of that, I think something people aren't talking about, PE bankruptcies are at an all-time high right now. And this notion that things are just going to be easy, PEI's got a report about operational excellence, and the next 15 years of private equity are going back to the old model. Roll up your sleeves, and our job is to professionalize these businesses, and not everything is going to check every single box. But I think to your point, those deals are definitely getting done. I think, especially with how much dry capital is out there, you need to roll your sleeves and find ways to still dig in on those opportunities. And the supply aspect of there's not that many of those in market, they're still getting done at premium valuations.
Yep. Yeah, I think we like simple, right? But the world's not simple. So appreciate you guys getting into some of the detail about that. But John, maybe I'll put you a little bit on the spot. At Compass, I know in normal times, maybe some of us remember what normal times look like, but I know firms are trying to do deals on both sides, right? Buying and selling in kind of equal measure. I don't know if that's the case this year. So are you feeling more like a buyer or more of a seller? What's your sentiment there?
I think it's both. I think it depends on, you look across your portfolio. Everyone hit it on the call. I think the average hold period is 7.3 years, right? You can only do so many CVs. Liquidity is at an all-time low. Distributions are at an all-time low. At some point, that's the model, right? You got to return capital. I think we're going to talk about this later, but going through CVs, Houlihan put out their inaugural report, which I think shows a trend of how much people are talking about it. But if you've got a business that is resilient in these times and there's a scarcity, I think 3,800 portcos are past that 5-year mark, closer to in that 5 to 12. Pittsburgh talked about it. Assets under management went from 1.5 trillion to 4.7 trillion over the last 10 years. There's a lot of bandwidth issues, I think, within PE firms where, to get new deals done, you gotta unlock that capital from prior deals. And so I think, both seller in this market, if it's an opportunity where you can return capital, put a win on the board, get back out there, find opportunities. But you're a buyer in this market if you have that strategic lens. And that strategic lens doesn't start 3 months ago when things got slow and now you've got to come up with thesis. It started, 18 months ago. And I think you're seeing more groups take that approach, just getting out at these conferences and networking, just meeting a lot of other firms, trade notes. And the trend is, heard from one banker, he thinks 90% of firms are taking a quote unquote thesis driven approach, whether that's deep thematic or not, I'm not sure, but it shows a trend of, you got to have an angle. I think, John Yoon, our managing partner, he came from a corporate strategy and development background where you had a reason to get into a business. And I think he's really done a good job of implementing that at Compass, but more groups are, I think, starting to take that model. And so you can be opportunistic. We just got a deal closed, new platform last week. We closed that restoration services platform with Ken, Heather's cousin, which was an awesome. But that took, 2 years, both of those, from ideation of the thesis to getting out to trade shows, industry conferences, talking to industry executives. It's not the easy path, but it is the path I think that more groups are going to start to take. But it is a moat as well, right? It's not, there's a ton of opportunities that come across our desk that, look like great businesses, but if it's not within a thesis, we're pretty, resilient on staying focused, which I think is definitely paid off for us in the long run.
Yeah. So get in early, take the long view, build those relationships and confidence over a long period of time. Heather, could I get you to comment on the same question?
Yeah, look, I mean, we're both. We're always opportunistic, and this firm, I would say, is probably more opportunistic from a sell side perspective, like not hiring a banker, but taking phone calls and really pursuing sell side opportunities that might be interesting for our portfolio companies. But I would say, look, we are embracing complexity. We go where most others do not. And so all your commentary around complexity resonates highly with NovaCap. We have tripled the size of our operations team in the last 2 years. Most of those individuals sit within like an accounting finance function, supporting our diligence and portfolio company efforts. And the other big portion of that sits in our legal department. And so we love carve-outs. We love corporate orphans. We love companies with accounting hair because we've got a lot of geeks on staff. But we're betting that our ops team can unlock that value. And so we're really trying to create our own opportunities. We just carved out a fairly large division from an older asset in our technology strategy and made it an investment in our newest fund. There's another asset in market that we're looking to combine with it. Like, it is super complex. It has taken hours and hours and hours of legal and tax work to get this right. We're also using CVs and secondaries as a sourcing tool, like I said before. We took an opportunity in our financial services strategy to take one of our MGAs and give liquidity to Fund 1, but made it our first platform in Fund 2 by making a transformational add-on, which was the first in the United States, where there's a very large TAM, much, much deeper than Canada. And I guess what we're most known for in the last 2 years is our take private of Nuvei. It's an asset that we had owned previously. We took it public. We just took it private again with Advent as a minority shareholder via a continuation vehicle, which according to our placement agent and other folks is the first time that's ever happened in the industry. So if nothing else, we are definitely leaning into complexity. And I would say the sector and theme-based stuff, when we talk about sourcing, we have built a different model, in my opinion, to tackle this market.
So that word continuation vehicles has come up a few times now. Why don't we jump into that one? I think it's one of the ways that firms are getting creative to generate liquidity. I'm curious to hear you all talk about ways that you might be getting creative and what sort of impact some of these new vehicles are having on the market. Kate, why don't you, if you have a point of view on that, would love to hear from you.
Yeah, I think it's a great solution. We've talked a lot on this call, on this panel, about how the hold period for private equity is elongating. Over that same time period, it feels as though the length of time between raising new funds has shortened, at least in our sector. A lot of the private equity focused funds in the government space feels like are raising a new fund every other year. And there just feels like there's just so much capital to deploy, and that's it's because of sort of maybe two trends. One, overall private equity continues to grow, and two, interest in the government services and tech space has been rapidly growing from private equity standpoint over the last 6 years. Private equity represented a quarter of all transactions a decade ago, and now they represent close to 75. So when you think about the activity, private equity continues to flood to our sector. But continuation vehicles absolutely are becoming much more common, as opposed, when you think about, your exit strategy. You no longer just need to sell to a strategic or sell to private equity. You can be more thoughtful about how to, alter the whole period and the exit for that. So we're certainly seeing it. And we're certainly seeing private equity maybe be a little bit longer in the whole period than we saw maybe 5-10 years ago. But
Kate, I have a question for you. Sorry to interrupt. When you say that you've seen that, when do potential buyers of companies you're selling tell you that might be their strategy for an asset?
Not
if
the
it's
buyers, our
like,
clients. So our clients or sellers that we're talking to may say that they're thinking through either an exit or utilize a continuation vehicle.
EV.
For sure,
Yeah.
there's multiple ways to sell, but even on the buy side, like with transformational add-ons happening and people using that as an opportunity to flip it into a CV or an SPV or something like that, like, I'm just curious, how much where is this capital coming from and how important that is to you guys, deciding kind of who makes it forward and who doesn't.
That makes no difference to us, right? We don't see it as much on the buy side. It's more seller opportunity. If they don't get the valuations they're thinking through for where we sit, when we're selling businesses, the buyers are typically not. That doesn't necessarily come into play. Okay, good question.
Yeah, and I think single asset CVs in that Hilarion report saw a strong uptick year over year, where it's tougher to find new platforms in this current market, and people are holding on to those quote unquote trophy assets where family offices used to have the benefit of that, and now I think it's been, but even cross fund transactions, selling between funds, I think it was actually outpaced CVs last year, and so I think that's a trend where if you can't go back out and find those opportunities, you say, hey, let's look through the portfolio and figure out what we want to continue to hold. And if you have a strong conviction, why not continue to hold that? But again, LPs want distribution. I think distribution at an all-time low, and you still got to put wins on the board where you can and have a full exit. But
yeah, Justin, Heather, I wonder if you guys have any comments on the activity you're seeing in the form, some of these new creative forms and what impact you think that's having.
I don't think I have anything to add specifically on the CV front, except one thing that we've seen that I don't know, I haven't heard people maybe talk about as much as, maybe two things. One, some of these continuation vehicles got done in 2021 and 2022 at some pretty aggressive multiples. And I think some of those same groups in certain situations wish they had sold the businesses in a normal process and realized a return and returned some more capital, because now they're trying to raise new funds and their DPI metrics are not where LPs want them to be, and so we've seen some examples of that. But maybe the other thing too, in terms of just creative kind of approaches to maximizing value for existing investments for private equity firms. I mean, this trend has been happening for a while, but we're definitely seeing from the institutionally backed side of our sell side business, more groups that are, they're not really running traditional broad auctions anymore, right? It's a much more concentrated, targeted, sort of like, warm conversation, fireside chats, early look, gold card buyers, whatever you want to call it. But, the approach tends to be pretty similar, and it's just a little bit more targeted, and you'll get reached out to by certain private equity firms asking about a new opportunity, and you're like, I think this is the third round of groups that they've gone out to, because other folks reached us to and got our opinion on this like 4 months ago, right? So there's no way they've been just doing their initial marketing that entire period. And so there's like more like staged kind of targeted discussions, especially again, like probably less so from the founder owned side of our business, although, there's still some elements of that, and more so from the private equity owned sell side mandates for Clearsight where that's happening. But that's all I'd add on kind of CV and getting creative is maybe that stage
And
targeted.
And just to double click on that point specifically, even I would say boutique firms are even starting to run those more limited quote unquote processes where, there's two sides of the coin. There's still some that are taking it out to the 300 groups that they know and getting 90 IYs, but heard from one in particular 20-person firm where MDs really said, hey, let's take it out to 20 people that have been inquiring about this industry for the last year, 2 years, and staying on our radar, really have approved thesis, not just a one-pager, but a robust thesis in the space. And I think a bonus point is you have that industry executive on board already and moving to that group, and then, like you said, opening it up from there, but starting with 20 groups and then slowly opening the doors, not just even at the market stage, but, I think at the boutique. You have to know about the deal even when they first have the conversation. They don't even have them engaged, tracking some opportunities for 18 months a year. And again, we don't compete in two broad auction processes, but, definitely seeing that as a trend, Justin.
I would absolutely say that to be true for what we're seeing. We very, very rarely participate in broadly shopped auctions unless we knew the company before it hit the market. I would say what we're building from a sourcing perspective at NovaCap is an engine that prioritizes sectors and themes across all of our strategies. And I think the bar is higher now for private equity firms in general. You need a point of view on the sector, and you need to know what you're looking for and what your messaging is. Get out early and then win when the deal comes to market because you already knew it was. So we have a very robust tracking and watch list system for prospects. I can't say I've built the muscle behind this. The firm is uniquely well positioned to reach out to targets directly given the sector focus. And we're building these relationships early and tracking how long we've known them leading up to a sale. 9 times out of 10, if a book just falls on our desk and we had no idea it was coming to market, 9 times out of 10, we're going to pass immediately. So we are really hyper focused on those themes within the sectors that we like, and also with the backdrop of resilience, right, as a filter, because in this uncertain macro environment, you have to have that. But the reach out directly to targets, we don't use buy side firms. This is all done directly via our sector leads, and they're just really thoughtful about building those relationships early. And we're leveraging technology and in some cases AI powered technology to do it. So it's fascinating.
And not to be a major, I'm sorry, go ahead.
Yeah, go ahead, Kate. Go ahead.
I was just going to say, not to be a major plug for myself and Justin and the advisors of the world, but I think this conversation is really why investment bankers can be a huge help when you're running a process, because it depends on the asset. In my mind, and in our sector, it really depends on the asset, the dynamics, the shareholder dynamics. And sometimes we'll reach out to 5 buyers. Sometimes it's 3. Sometimes it's 1. Sometimes it's 20. Sometimes it's 60. It's at least in the government space, it's become crowded. There's more than 125 private equity backed assets looking to acquire and grow in the government space. So there's no shortage of buyers. There's no shortage of buyer demand. Sometimes it does make sense to go to a limited group of folks. And like I said, we are always thinking through whether it's fireside chats, whether it's broad is not 300 in our world, it's maybe 60, but through what that looks like. And it's being able to think strategically about how to leverage the buyer universe and the timing of the kind of the market dynamics.
Yeah, I agree. I repeat this all the time to my team. Do not be a book taker in this market. You have to be selective, and you got to have a clear investment point of view and be concise about what you're looking for. Don't be a book taker, because then that sector banker that's driving that cybersecurity software deal Like how are they to know what we like in cybersecurity or not unless we're connecting directly with that sector banker through our investment team? Like that
Yeah.
type of sourcing engine is what we've built at NovaCap.
So let's jump in there a little bit. On the way, just want to remind the audience we're coming into the last 15 minutes of the program. So if you have specific questions you'd like to ask the panel, please put them through in the question panel and the GoToWebinar panel, and we'll save some time at the end to get through a number of those. But on the way, I want to get to this topic of deal sourcing technology and AI specifically. I think access to the data and the technology that can automate a lot of these steps and really drive targeted processes like you're describing, Heather, have become more accessible. They've become more affordable. The technology's become much easier. And so I think we are seeing broader uptake and use of those tools. More and more firms at least adding a direct sourcing process into the mix of ways that they're finding deals. I mentioned at the top, we just ran a survey with a bunch of private equity deal makers, and we got a couple of surprising results, some of it not so surprising, some of it surprising. About 70% of the people who responded to the survey said that they have used AI-driven tools for productivity. I thought that was kind of a surprisingly, and we didn't ask that in a narrow deal sourcing way. We asked that just broadly in your professional work. So that was kind of surprising me. And 10% not using AI technology at all. And some of that may have to do with obviously accuracy and reliability of the results you're looking at when you're using AI-driven tools has been an issue. But close to 50% of the people we surveyed still see accuracy of results as the biggest obstacle to using these kinds of tools more broadly. So we're at this interesting point, I think, in the adoption of these tools where it's happening really fast. The evolution of these tools and the capabilities is really, really happening fast. But surprisingly, there are still some people sitting on the sidelines. But I'd love to, I think this is a really valuable topic for a lot of people listening in today. Would love to hear you guys talk a little bit about your own experiences, your firm experiences. Heather, I think ahead of our session today, you talked about how far you feel you're ahead of the game a little bit where this is concerned in your use of these tools. So maybe we'll start with you, but I'd love to get each of your takes on this topic.
Yeah, ahead, but to be behind, not in the near term, and that's okay with us. And I'll explain why. We hired a CTO about 2 years ago, and I cannot impress upon you all how game changing it was to have business leadership at running our technology strategy and data platforms at a private equity firm our size. Complete game changer. And I would say, the anecdote I threw out earlier was the head of ChatGPT OpenAI called our CTO last month and said, "What the hell are you guys doing over there?" And Tim's like, "What do you mean?" And he said, "Well, you guys were the #1 user across all of Canada by the number of prompts. We had over 40,000 prompts across our enterprise customers in all of Canada. Like, what are you doing?" And the reality is he's built a safe space for us to use AI in a way that protects us and our information from being public and vice versa, and letting people do what they do. This younger generation, it's just giving them a safe place and a tool that's protected cyber-wise and whatever else, and letting them play. And it has been a game changer. We have 175 bots deployed across the firm. I have a deal screening bot called Deela, D-E-E-L-A. Yes, I use ChatGPT to come up with the name. But it is given me a tremendous amount of efficiency because if anything, my a big chunk of my time is turning deals down. And the #1 differentiator in my mind for BD professionals today is actually responding within 24 hours when a deal hits your inbox. And lots of people just don't respond at all. Radio silence is not a no. And it's crazy. It's a differentiator to be responding quickly to deals. But I use the teaser. It screens it. It gives me a summary. It gives me an assessment bit across all our 4 strategies. And it even drafts an email for me. And it's about 80 to 90% accurate. So those turndowns, when we talk about making a thoughtful turn down and actually saying, this isn't what we like, but here is what we like. It's an incredible efficiency tool for us. And then I will just comment on one other way. We are prototyping something that that will really it works across all the data platforms that we have access to, and drives insight and trends into the types of businesses we want to buy based on a very narrow set of filters within our sectors, within specific sectors, giving us key signals for when it might be coming to market. It integrates Sourcescrub and all the data that we see from conferences and trade shows there. I mean, there is lots of things happening. I would say our viewpoint generally, though, is Tim always says, I want to be credible. If I pick a tool and someone else does it better, or it falls apart, or it's not safe, that's my ass on the line. And so I think reputationally, private equity firms are being cautious. We are being cautious, which is why I say we're ahead now, but I know there's lots more tools coming out. We are just very intentional and thoughtful about when we pick a tool that it's got length. So
it's interesting automating those kinds of processes, because it seems to be one of the most interesting use cases for people. But across the customers we work with, you talk about them, what's their secret sauce for sourcing and business development? It's all about the quality and personalization of that outreach. It's about, and so the idea of automating that certainly is appealing, but not without downside that you're not doing it right.
Approach and tone that you need, right? Like it can't, and that's why you can train those. It's actually mind blowing.
And I was on a panel for, AI and PE, and, some lawyers on the panel, some bankers on the panel, and everybody, a lot of concerns around just data, right? But if you operate on a closed loop system using various forms of AI, we do a lot of direct outreach internally. Every time we get an active thesis, it's, a lot of calls, as well as, how can you customize and be professional? But then going back to, I think, to Heather's point, how do you stand out as a BD professional, offer concise, clear feedback? You do that on the 1,000 deals you see a year, which is not easy, just looking at my inbox already, but after being on this panel, but you got to do it. I mean, being responsive, being clear, concise messaging, and doing it. I think BCG had a report. It was like, how do you become 37% more efficient in your current role? If somebody came to you and said, you can have 4 hours of work back on your calendar, AI is the way to do that, and figuring out ways to be more efficient, especially as you're reviewing everything.
Mike, I want to make one more point, because I think it's exactly the next tier for AI, for sourcing, and for PE overall, and we're doing it already, is how do you query all the data that we've accumulated as a firm in our CRMs, in our fundraising databases? Like, it's not just about doing a smart search. It's about using an AI-powered tool to query the data. Hey, give me a summary of our relationship with Piper Sandler, and it just immediately spits out like everything. Or give me the trends that we're seeing in data center cap rates over the last 12 months, taking all our emails and interactions that we've uploaded. So I've always been about single source of truth for data. The reason to have good data and quality data is to use AI eventually to query it. And I know DealCloud and others are coming out with similar tools very soon.
Yeah, and that's where you mentioned hiring a CTO not so long ago. And certainly this is where the value of a CTO comes in, having data sets that are knit together and accessible through some of these new, there's really exciting tools coming on the market now that do the kinds of things you're talking about. But if you don't have the right data and the right infrastructure, you're not going to get very far with it. But Justin, Kate, maybe we can get your voices in here from the investment banking side of the way AI is being used effectively. What have your experiences been? Where are you finding real promise and potential? What advice might you give to people listening in?
Yeah. Well, I'll go, because it'll be very short, Mike. And I'm curious. I'm curious, based on your survey, if I think you said 10% are not using it all, if there was any option for folks to select compliance or regulatory hurdles that prevented them from using those technologies. Because if so, I don't think I completed the survey, but I and my colleagues would be in that bucket. And so what I'm told is, and maybe helpful for the audience, Kate mentioned their transaction, Kips's transaction with Capital One. Clearsight just over 3 years, actually closer to 3.5 years ago now, we consummated our own transaction and sold Clearsight to Regions Financial, which is a publicly traded bank holding company with about 150 billion in assets based in Birmingham, Alabama. And they've been a fantastic partner. But as part of that, the evolution and kind of processes around acquiring any new access to any new technologies, as you can imagine, is a bit more complex. And so we do not have any access today. I am told we are getting access to a closed loop version of Copilot, as well as, I can't remember which LLM. I think it's a ChatGPT subscription and kind of, closed sandbox or whatever the right nomenclature is for being able to use that in the next couple months, but have not been able to use those technologies to date.
Put it on your
Kate,
personal.
I think you mentioned.
Yeah.
No, if anybody from Regions is listening, would never do that.
We actually
Let's use it personally.
Kate was doing some exciting things as well. Yeah.
We were in the same boat as you until literally last week, and we just got access to Capital One's approved ChatGPT. It's Gemini. And so we're still digesting, learning, figuring out how to utilize it in the best ways. I think with respect to buyers, that's a tough one because that really is your internal IP, right? Us knowing, and Heather, I think you raised this point, a lot of what I and my colleagues spend time on is getting to know the buyers. That's our IP, is understanding exactly what SAIC or Booz Allen or private equity A, B, or C and their platform companies is looking to acquire, so that we can say these should be the 5, 10, 20 buyers that should be on this list, and we have those relationships. So the chat GPT tools will only be as good as the data in your CRM if you're going to use them. Otherwise, it's getting that information out of our collective heads into a format that we can use. So we're still working through getting that into our CRM. I think that'll be probably a slower change because it's so strategic and it's so, and a lot of times what we do is just on a deal recently, we were thinking through who to use our 7 bullets on for pre-market meetings with an asset of size that we're bringing to market. And honestly, what I did is, because I could easily make an argument to put 30 buyers on the buyers list, I set up 16 calls with the 16 best buyers and did pre-market meeting marketing, where I set up these half an hour conversations and just like, hey, I know we chatted a month ago, but right now, what are you looking for? And then we distilled those 16 into 7 people that we recommended for fireside chats. And so that's going to be something that I think will continue to be a banker's IP. But how can we leverage AI to help us with teasers, to help us with SIP development, to help us with some of the more junior type activities to make us more efficient and allow senior bankers to spend less time reviewing, processing, doing some of those administrative type work and doing more of those higher value activities like interacting with the public companies and the largest and most active buyers, so that our IP and our brains is as sharp as it can be. So I think it's evolving. We haven't necessarily gotten there. I think if you ask me this question in 12 months or 24 months, it'll be a much more interesting answer, just given that we just got access to our AI tool.
And I would throw out one last thing, anybody dipping a toe in the water and just curious about the space, Taylor at Metal AI, he's up in New York. They're doing a lot of really interesting things on aggregating data from your CRM and synthesizing that data. A lot of that stuff Heather talked about with their CTO. We've got a CTO as well. I think anybody just even curious learning about how to do that would be a great resource. And obviously our hosts at Sourcescrub, we look at, all of within our thesis, what's our buyer or market universe platforms, how many people have they added on LinkedIn? Some of those AI trends that you're not going through and manually doing that, I think is crucial with how to get smart, quick, and focus in on the right targets. So
yeah,
Mike, you guys are doing great things over there.
Thank you. To Heather's point, the more that you can harness the data that you've already got available, right, the more effective you're going to be. And that's been one of the challenges historically, is to take advantage of all the data points that you do have in AI summarization. And a lot of this stuff is really adding a lot of power to stuff that you've already got, sitting around. Justin, I looked up some of the results from that survey because I was kind of curious about your point about compliance and legal. And when you look at the question asking about obstacles, 10% of the people responding said that it was compliance and legal that were preventing them from. So it's probably not a coincidence that it's 10% who are sitting on the sidelines. I think it's that same 10%.
Yeah, makes sense.
So we are at time. I think that's probably a good place to leave it. As we wrap up, I want to say thank you very much, John, Justin, Kate, Heather. It's been a great conversation. I really enjoyed myself. Really appreciate you guys joining us today for the conversation. And David at PE Careers, great resource for everyone out there. I think everyone who's joined the conversation today understands that, but want to say thank you to you for allowing me to host the conversation, and say thanks for putting this all together, getting such a good group together. Really look forward to the next one. Thank you guys again for the time, and I hope you all have a great day today.
Thanks, everyone.
Thanks, everyone.
Thanks,
so
guys.
much.
Appreciate it.
Have a good
Thanks,
one.
Mike.